You know how running a business sometimes feels like juggling flaming swords? One day cash is flowing smoothly, the next day you're scrambling to cover payroll, inventory, or some random expense you didn't see coming. That's where cards like the Revolut Visa card steps in, promising to be your business's lifeline when money gets tight. But here's the catch. While it looks like a handy tool for smoothing out cash flow, it might just sneak up on you and burn a hole in your budget. This isn't your typical credit card with interest rates and rewards programs. Nope. The Revolut credit card works differently. It uses something called a factor rate, which can be a lifesaver for some business owners, but a serious money drain for others. So the real question is the Revolut card the reliable sidekick your business needs? Well, let's break it down together and see if it's worth adding to your financial toolkit. So who is the Revolut card good for? The Revolut Visa card is designed for a very specific type of business owner in mind. Unlike traditional credit cards that rely heavily on your personal credit score, Revolut looks instead at your business revenue. That means even if your personal credit history isn't stellar, or if you've been turned down by other business credit cards, you still have a decent shot at approval here. This card is particularly suited for business owners with poor or limited credit. Since approval is based on cash flow rather than your FICO score, it's accessible to entrepreneurs who may have struggled with traditional financing. Companies with consistent recurring revenue. Revolut isn't just checking whether you bring in money. They're looking for regular income streams. Businesses with steady deposits like e-commerce, retail, or service-based companies are more likely to qualify. Small businesses needing quick access to working capital. If you often find yourself in tight cash flow situations, covering payroll, purchasing inventory, or bridging short-term expenses, this card can provide fast, flexible funding. Owners who don't want to deal with annual fees or traditional interest charges. The Revolut card doesn't carry an annual fee, and instead of charging an APR on balances, it uses factor rates. This can be attractive for someone who wants predictable repayments tied to their revenue rather than compounding interest. On the flip side, if your business revenue is inconsistent, seasonal, or if you're looking for a card with rewards, long-term financing or perks, this probably won't be a good fit. The Revolut card is more of a cash flow tool than a traditional credit card. How the Revolut card works. The Revolut credit card looks like a typical business Visa, but it doesn't function like your average credit card. Instead of offering a revolving line of credit with an APR, it's structured around a revenue-based financing model. That's where things get interesting and a little complicated. Here's the key difference. Traditional credit cards lend you money, charge interest, which is an APR, and expect minimum monthly payments. The Revolut card gives you access to funds based on your future sales revenue. In simple terms, Revolut is essentially buying a portion of your future receivables at a discount. Now, let's break that down further. Funding is based on revenue, not credit. Instead of looking at your credit score, Revolut evaluates your recent bank statements to see how much cash your business consistently brings in. The more predictable your income, the higher your spending limit is likely to be. Factor rates replace APRs. Instead of charging interest, Revolut applies a factor rate, typically ranging from about 1.1 to 1.5. For example, if you draw $10,000 with a 1.4 factor rate, you'll owe $14,000 total, no matter how quickly or slowly you pay it off. That fixed repayment amount is what makes this structure very different from traditional credit cards. Automatic repayments. Repayment is usually collected automatically through daily or weekly deductions from your business bank account. The percentage they take is tied to your revenue. So if you have a slower sales week, you'll pay back a little less. And when sales pick up, you'll pay more. The Flex Line. One of the unique features is Revolut's Flex Line, which acts like a revolving funding source. Once you've repaid a portion of what you've borrowed, that amount becomes available again, similar to how a traditional credit line works. The big difference is, every time you draw funds, the factor rate kicks in on that new advance. No personal liability in many cases. Since it's tied to your business's revenue, not your personal credit, your personal assets aren't usually at risk the way they might be with a traditional business credit card or loan, though terms can vary. In short, the Revolut card isn't really a credit card in the traditional sense. It's more of a revenue-based financing tool disguised as a Visa card. For some businesses, this setup provides much needed flexibility and fast cash access. For others, especially those with thin margins, the repayment structure can be difficult. So does the Revolut card help build business credit? Yes, and this is one of the under-the-radar advantages of the Revolut Visa card. While it doesn't report to the consumer credit bureaus, so it won't impact your personal credit, it does report to Dun & Bradstreet, one of the major commercial credit bureaus. So why does this matter? Well, first of all, it builds your business credit profile. Consistent repayment activity with Revolut gets reported, helping your business establish or strengthen its D&B Paydex score. It opens the door to better financing. A stronger business credit profile makes it easier to qualify for traditional business loans, lines of credit, and other cards in the future, often at a much lower cost. And finally, it separates business from personal. Since it's tied to your business revenue, not your personal credit score, it helps keep your financing history cleanly separated. In other words, for small businesses that have steady sales but limited or no established credit, the Revenue card isn't just about immediate cash flow. It's also a stepping stone towards stronger, long-term financing options. A detailed cost example. To understand the true cost of the Revenue card, let's walk through a simple scenario. Suppose your business draws $20,000 from your Revenue Flex line, and you're given a 1.4 factor rate. With a traditional credit card, you'd pay interest over time, say 20% APR, and the faster you pay it off, the less interest you pay. With Revenue, that factor rate is fixed. That means no matter what, you'll owe $28,000 total, $20,000 times 1.4. Here's how that might play out. Advance taken, $20,000. Factor rate, 1.4, 40% cost of borrowing. Total owed, $28,000. Total financing cost, $8,000. Now, repayments aren't monthly. They're based on your daily or weekly revenue. For example, if Revenue is taking 10% of your daily sales and your business averages $2,000 in sales per day, then $200 a day would automatically go towards repayment. At that pace, it would take roughly 140 days, about 4.5 months, to fully repay the $28,000. But here's the kicker. Even if you repaid it in just a month, you'd still owe the full $28,000. Unlike an APR, paying early doesn't reduce your cost. Why this matters? This structure can make Revenue much more expensive than a typical credit card or line of credit, especially if your business has strong cash flow and could otherwise qualify for cheaper financing. However, for businesses shut out of traditional lending because of poor credit or limited credit history, that $20,000 today, even at a $28,000 total repayment, can be the difference between survival and shutting down. General comparison to a traditional business credit card. Alright, so let's put the Revenue card head to head with the traditional business credit card, because this is where things really start to make sense. First, approval criteria. With the Revenue card, your approval is based on your business's revenue, not your credit score. That means even if your personal credit isn't great, you can still get approved. Traditional business cards, on the other hand, almost always look at your personal credit, usually looking for a score of around 680 or higher. Next, let's talk about the cost of borrowing. This is the big one. With Revenue, you're dealing with factor rates. So if you borrow $20,000 at a 1.4 factor rate, you're paying back $28,000 no matter how fast you pay it off. With a traditional card, you're dealing with APR. That could be anywhere from 15% to 25%. But here's the difference. If you pay it off quickly, you save on interest. With Revenue, you don't save by paying early. Then there's repayment structure. Revenue takes automatic payments straight out of your sales, either daily or weekly. It adjusts with your revenue, which can be helpful if your sales dip, but it also means less control. Traditional credit cards are monthly. You decide how much above the minimum you pay, which gives you a lot more flexibility. What about rewards and perks? Traditional business cards almost always offer points, miles, cashback, or travel perks. With Revenue, there are no rewards. It's a pure financing tool. And finally, fees. The Revenue card has no annual fee, which sounds great, but remember you're paying through factor rates, which is where the real cost comes in. Traditional business cards can range from no annual fee up to $695 or more. But those higher fee cards often come loaded with perks that can offset the cost. So who is each card best for? The Revenue card is designed for businesses with steady revenue but poor or limited credit history. Basically, people who can't qualify for traditional financing. Traditional business cards are better suited for businesses with good credit that want lower costs, flexible repayments, and rewards. In short, Revenue gives you access when nobody else will. But if you can qualify for a standard business card, that's almost always the better long-term option. Pros and cons of the Revenue card. Like most financial products, the Revenue card has its strengths and weaknesses. Here's how it stacks up. Some of the pros are, it is accessible to business owners with bad or no credit. Since approval is based on your revenue, not your personal credit score, it's one of the few funding options for businesses with less than perfect credit. It offers fast approval and quick access to funds. Applications are typically processed quickly and, once approved, you can access cash fast, helpful in emergencies. A flexible credit limit, revenue-based. Your spending limit grows with your business's revenue. The stronger and more consistent your sales, the more funding you'll have access to. No annual fee or traditional APR. Unlike many business cards, there's no annual fee to worry about. And since factor rates are fixed, you won't deal with compounding interest. Automatic repayments linked to sales. Payments adjust to your revenue. If sales are down, payments shrink. If sales are up, they accelerate. This can ease the pressure of fixed monthly payments. Now for some of the cons. Expensive factor rates. Costs typically range from 1.1 to 1.5. Which means borrowing $20,000 could easily cost you $28,000 to repay. That's far higher than most traditional business financing options. No rewards or perks. Unlike other business credit cards, there are no points, miles, or cashback programs. This card is purely a financing tool. Daily or weekly repayments can hurt cash flow, while flexible, frequent deductions from your sales can make it harder to manage day-to-day expenses if margins are already tight. No benefit to paying early. With APR-based products, paying off early saves interest. With Revenud's fixed factor rate, you pay the same total whether you repay in 30 days or 6 months. Limited use cases. This isn't a great option for businesses seeking long-term financing or growth capital. It's really meant for short-term working capital needs. In summary, the Revenue card can be a lifesaver for small businesses locked out of traditional credit, but it's not cheap. For those with strong credit or access to standard business credit cards, it's usually more cost-effective to look elsewhere, should you get the Revenue card. So here's the bottom line. The Revenue card isn't your standard business credit card. It's really a financing tool wrapped in a Visa logo. If your business has steady revenue but limited access to traditional credit, this card can actually be a smart option. It gives you fast access to working capital without relying on your personal credit score. And for a lot of small business owners, that's a huge win. Now, it's true, factor rates can make this an expensive way to borrow, and it doesn't come with the perks or rewards you'd find on a traditional business card. But if your priority is reliable access to cash flow when you need it, Revenue does exactly what it promises. So who's it good for? Businesses with consistent sales that want flexible funding, even if their credit history isn't perfect. On the other hand, if you have strong credit and qualify for traditional business cards, you'll probably save money and get more benefits going that route. Either way, it's about matching the right tool to your business needs. Now, if you found this review helpful, make sure to like this video and subscribe. I've got plenty more credit card reviews and business money tips coming your way, and you won't want to miss them.